Hello again, another Tuesday evening. I hope everybody is well. Can you believe it? And they come around every week. What a surprise. We'll just put the pre-show on for a moment or two as we count down to 8 p.m. And pleased to say everything's working here. Damien is ready to come in. You can see that. He's teed up over there. Here's the studio in its normal state. Everything else is working. And it is, I think, all fingers crossed in place. Doggies are here. They're a little more huddled tonight because it's quite a lot colder here relative to last week. We had a very warm week. We're now back to normal, although there are thunderstorms around. So if the dog starts getting antsy, it'll be because the thunderstorms are there, or it's because we've got the bins being collected. Either of those are possible. Anyway, I think we're good to go. And we've now hit the 8 p.m. watershed, so I'll take the pre-show off. I'm going to start the show formally. I'll be back in just a moment. Well, good evening. Welcome to this live stream on the 2nd of June 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. And of course, we've just entered winter. So I guess spring won't be far behind. The El Nino is looking pretty severe as well. I saw there was a report out today that it could be one of the biggest, the Godzilla of El Ninos. So I'm not sure what that's going to do to crop yields and all sorts of things. So I guess we'll know later on. Anyway, we're all good to go. But before I bring Damien in, remind you that we're not providing specific financial or legal advice on the channel here. It's a general conversation only. This is as at the 2nd of June if you're watching in replay. And if you'd like to ask a specific question live, use Walk the World DFA to get my attention. That goes into my queue, and that'll mean I can get your question into Damien and myself. I've also enabled Super Chat so you can get your question to the top of the list, or indeed make a contribution to what we do around here. And we really appreciate those who support us via Super Chat, Patreon, or PayPal. Makes a huge difference. We don't just profit, we just because there's a really important conversation we had, particularly now. Let me bring Damien straight in. Damien, welcome back. How are you?
Not too bad, Martin. Not too bad. I seem very, very busy. It all seems to be happening as we keep speaking about.
Well, there is quite a lot to talk about. And look, we're going to have quite a crowded agenda this evening because I think there are some really big lumpy things. So I want to talk about the mega bubbles in the US with regard to Macquarie came out and said, look, investors in the US are jumping from bubble to bubble to bubble. So it was the Magnificent Seven, then it was the chip makers, and it's going on and on, right? And of course, yesterday we had Nvidia announce a chip for the PC, and so Microsoft shares shot up as well. And of course, in the US, we keep hitting all-time highs. So I want to talk about that, and also talk about some of the IPOs and some of the big listings that are coming up and what that could do, SpaceX and a few other things, Anthropic as well. Then, of course, we've got the budget in Australia and the fallout. And I'm interested in particularly your perspective with regard to the investments and, the difference, for example, of holding ETFs versus ordinary shares and all those things. There's a bunch of questions there. And maybe your thoughts on whether they're going to pull back or whether it's going to be maintained. And then, of course, we've got the broader question of, well, how is this all going to play out ahead, and a bunch of other issues that we're going to touch on too. I know you've got a few things you want to touch on.
End of financial year as well.
End of financial year being, I was going to say, one of the big ones. Now, are there things that people should be thinking about just as they begin to move towards the end of the financial year? Because frankly, things are going to get interesting next year, particularly with some of the recent changes. Thank you very much for the super chat, by the way. Really appreciate that. And Smooth, nice to see you in there. Anyway, what's your initial take, Damien? Oil, of course. What's happening in the Middle East?
Oil, yes.
Oh, there's a few things. So we could be here for 6 hours.
That's right. And stay close to your Truth Social, just in case we get a tweet while we're on. There might be something else for us to deal with. Yes.
So let's start with the US.
Okay. And the stock. Let's start and let's talk stocks. Start with. It's interesting that the semiconductor, the latest stuff we've seen from that, it might well be a bubble, and it probably is in many ways. but it's a bit of an earnings bubble, which is a weird way of saying it. So I thought what I'd do is I might bring up Micron. I've just got a chart up showing just Micron's share price chart, just because it's yeah, they're at the pointy end of this one. They're the poster child for a cyclical company, and so you can see that they're up 1,000% over the last 5 years. Over that, what we're missing on that, I probably should put it on a log scale, is that they go through these frequent periods, and I'm about to show their 20-year, or maybe 30-year history of earnings. And as you can see from this line, it's basically, and this is a log scale, this one, but they basically go to making a loss every 4 to 5 years. They sort of go through like clockwork, just, up, down. Their earnings just go dramatically from one end to the other. We're in 2026 now, looking at sort of 90 for earnings in 92 for earnings next year. It was 21 this year, so sort of going to go 4 times in terms of earnings is expected. And 2 years ago, they were making a loss, and so it's this weird thing in this semiconductor industry, and there's a lot of other companies like this in the semiconductors, but not as bad. Like these guys are much more extreme. And so the story that what generally happens for Micron is there's only three really big players in this space for doing memory, and when they build factories, they build really, really big factories nowadays, just because, a factory might do 5% of world demand or something like that, the new factory. And so they're just like these massive, massive undertakings in these big CapEx cycles they go through. And so what happens is nobody builds anything because they've all been losing money. Demand sort of gradually builds up. They get shortages. And then all of a sudden, one of them goes, "Hey, I'm going to build myself a new factory." And all the others go, "Well, just a minute, if you're building a new factory, then you're going to suddenly take up 5 or 10% of world demand. And so I can't let you do that if I don't build a factory. So I'm going to build a factory as well." And then they all build a factory, and then the world gets flooded with the parts, and off they go. And so, that's sort of where we are. The memory guys in particular are now, well, they're all getting in on the data center action. So they're all sort of, and so they're higher end chips and all that type of stuff like that. And so they've got that going on. There's also the part about the shortages in helium, and there's issues around supply chains and stuff like that. And so it is a little bit harder to build, but they're all out there building factories, and probably next year, and they won't be on this year. It'll be 2027, 2028 story. So that'll turn at some point. And if you go through one by one through different sectors and different parts of it, it's a similar type of story. There's just this mad demand and mad rush for data centers. But the earnings is backing it up. And so the thing is with Micron is, so currently it's sort of trading on 15, 16 times earnings, which sounds pretty reasonable. You're like, oh, yeah, that's not too bad. But Micron, it'll trade at 2 times earnings or 3 times earnings at the peak of the cycle, because everyone sees it coming and everyone's like, just a minute, I know they're making whatever, they're making 100, but their factories are all about to hit, and they'll probably be loss making as of next year, and so they're not going to pay massive multiples for it. So 15 times this earnings is sort of like, well, I don't know. It's a weird spot. It's not. It's certainly this is the sort of pricing. Well, earnings are just weird in that they're so cyclical. It's very hard to sort of take this and draw a conclusion about whether it's cheap or expensive just merely based on that. And so you sort of got to be really aware of where we are in the cycle, and who's sort of capex building and all that type of stuff. And so yeah, so I guess what I'm getting to with this is this latest one we've seen, where the semiconductors index has really just taken off. There's it's a bubble, but it's a bubble in earnings. And so the question is, when does that earnings roll over? Because that's the time these stocks will all go back to trading on much lower valuations and much lower, and their earnings will fall at the same time. And so, yeah, you don't want to be holding it when the music stops, but when is the music going to stop? Well, for these guys, they've probably got for them these different sectors, but these memory makers, the new ones aren't coming on until next year or the year after. And so, it's it's sort of this. Yeah, I don't know when it's going to finish. is the answer. I know it'll finish because it does. These guys frequently when these things go, it frequently halve or more than halve in price, as that hits. But and as we showed on that chart, it does it like clockwork every 4 to 5 years. Question is, if you've got another 2 years to run on that, then happy days. And it probably is a little while before we see the end of that one. So.
And it's interesting because SK Hynix, for example, which is another example of a boom stock. This is actually their latest trend. This is a South Korean stock, right?
Yes. So they're a competitor, main competitor. The three big
Correct.
ones: Samsung, SK Hynix, and Micron in the memory space. But then
But
lots of other different
interesting
spaces.
about this is that this would have been sitting within emerging markets stocks, right?
Yeah,
And so what it actually
yeah,
means is that because you've got these big stocks now sitting in emerging markets, the emerging markets sector itself is completely different from what it was a couple of years ago.
yeah. Well, and this weird thing with emerging markets in that they sound really big. You're like, oh, there's a billion people in India. Surely that must be a really big in the emerging markets. You're like, no, it's not that big. And so really, if you were emerging markets, say 10 years ago, all that really mattered to you was what's your exposure to the big Chinese internet stocks and Chinese state-owned entities. Like, that's basically going to, a huge proportion of your index. If you get that right, you'll outperform. If you get it wrong, you'll underperform. Now it's basically, what do you think about Samsung and SK Hynix? Yeah. What do you think about the memory chip ones, TSMC, if it's in your index or not? But there's basically, just this handful of stocks. What do you think about those? Because they're just going to dominate those portfolios. And, a company like, or, let's say, well, if you toss one of those companies into the Australian market, it'd be, whatever, 50% of the Australian market or something like that, or more. So it's the part about going, well, what you're expecting if you say, oh yeah, I'd like to buy an emerging market stock, you're like, oh, okay, I'm going to get exposure to some companies that are, in India and growing, or they're a telco player in Brazil, or whatever it is, and you're like, oh no, I've actually just got these stocks that are actually, SK Hynix, which is effectively the same as Micron, a US listed stock. It just happens to be in South Korea, and so you're getting much more of a developed market exposure than what you might have thought you were getting.
The other thing, of course, if you look at the US, the results season that just came through was pretty strong at an aggregate
It
level.
was
it
a
was way
cracking,
above
a
what people
cracking one.
expected, right? Yeah.
Yes.
But
Yeah.
if you look carefully, not all sectors reported strong results.
No, and many of them were weak results,
Yes.
but there was companies like this one that have gone from that basically in the case of a year I think their profits are up maybe 3 times higher, 4 times higher, something like that, and so you just like it's uh, the steepness of the line, though, in terms of the growth forecasts for the US earnings, has basically, it's steeper than what it was coming out of the financial crisis. It's steeper than what it was coming out of COVID. Like it's gone vertical in terms of the forecasts, the earnings forecast on these stocks, and so that's clearly not sustainable. But it's a very good sign. And there are there's other signs in the US as well of of sort of increasing growth, like a broader base growth. And so trucking, for example, especially trucking in the middle of the US, is actually there's really high demand for it, and the rates they're charging has sort of gone up. And flatbed trucks is one of the big ones that sort of, these are things that just carry stuff around. It's not sort of not as much consumer goods. It's more for construction and other bits and pieces, and big coils of wire and stuff like that. And so the question is there this boom sort of going on within the US that's a little bit above and beyond that, above and beyond, or is it spreading out? And maybe some of this is that these companies, these IT companies, your Microsofts and Nvidias and all that, have been making so much. Oh, sorry, Nvidia not as much. They're more of a recent one, but Microsoft, Google, Amazon, have been making so much cash and just nothing to do with it. They're just going out buying their own shares with it, or letting it pile up. And now they're actually outspending that money. And so it's this thing about, well, okay, it's not because it's capital expenditure, their profits are still really high because it's basically saying rather than taking their profits and going, I don't know what to do with it, I'll just buy back some more shares or throw it in the bank or do whatever. Whereas now they're actually, I know what to do with that money. I'm going to go out and build data centers. And so the thing is, well, maybe there's just this whole, that's just recirculating now in the economy. You get the multiplier effect that, they go out and spend it. And there is somebody with a Caterpillar truck digging a hole for you to put this in. And we've got a whole bunch of workers in building this stuff. And so they're going to need sandwiches and they're going to need, whatever it is that money just sort of starts to circulate around and it's self-reinforcing. And so, if you do have a CapEx boom, you're effectively what we're saying is we're going to take money from savings that people are saving it. And I think this is a little bit of a case in the AI as well, is that there's people out there going, yes, I was saving this money, but actually, you know what? Now I really want to invest in the Anthropic or I want to invest in SpaceX or something like that. And so maybe they'll be losing money, maybe they won't. But for some part of this, it's actually saying, well, we're taking that money, we're giving it to this company, and this company is going to go out and spend that money, and that's going to circulate in the economy. And so, there's this sort of argument around that, which is like, well, a lot of this looks like it's publish, and there's issue. We'll talk about the IPOs and when does it finish and all that type of stuff. Can this go on forever? No, we can't just keep spending these ridiculous amounts of money forever. But can you keep spending it for a while, and is it good for the rest of the economy while you do it? Yes. And so where does the end come? Is the critical question, which sort of I think everyone's asking. But it's certainly not. As we spoke about last time, given the earnings, it's certainly not looking imminent in terms of we're closing in on the end. And if you took the view that, which we'll talk a little bit about when we start talking SpaceX and IPOs and all that type of stuff like that, if you took the view that, look, the market's got this sort of tolerance for saying, it's absorbing capital. It's basically saying it's what to provide capital to growth things. And so when if I look at the internet boom, it's sort of like at the time they were like, oh well, everyone's like, oh, I want to put money in this internet stuff. I've heard about that, and I can't find enough companies, and the companies are really expensive, and so all these new companies started listing and saying, oh, I'll take your money, I'll go and spend it. And so we haven't really had that in this part so far. But if we start getting a whole bunch of $1 trillion companies listing, and they're all relatively low floats to start with, but that'll increase. And then all the original founders are all selling out and chipping all their money out to everyone who wants to invest in this. Is that that'll help solve the problem of too many people chasing AI and not enough companies. Is that and then once everyone's got enough and the growth rates start to falter, and then that whole thing can go in reverse, because when people stop spending the capex, that multiplier effect that worked on the way up is also working on the way down.
And it's interesting because some of the regulations that came into the US have helped with some of the depreciation and the way the depreciation works for some of these companies, right? So it allows them to effectively benefit from that, which is another little factoid that a lot of people haven't picked up on.
Yeah. I think we spoke a little bit before in the past. They did make it. They did extend it a few years ago. So they sort of said, "Oh, these depreciations." Oh, sorry, what they? Yeah, they were like, I think they were depreciating over 3 or 4 years. And they moved it the wrong way. Maybe it was 5 years. Maybe it was 5 years and they moved it back to 4 years or something like that. And then they were like, actually, no, these things are lasting longer. And then they moved it back out to 5 years for a lot of companies. Yeah. So they did make it worse before they put it back again. But it does add to your earnings, to your bottom line earnings. And and there's that. That's certainly an issue around that whole thing.
So really high indices in the US, right? So whether you look at the 500 or whether you look at the Dow, or if you look at the other ones, they're all pretty high, driven by this AI story, driven by this chip story, particularly driven.
The valuation isn't as high as what it was 6 months ago.
Correct. Exactly.
Because the earnings have been so strong.
Yeah, and that's going to say, the point is there was an underpinning of earnings, but not uniformly spread. So the markets were definitely fixated on that. They weren't fixated on things like the higher bond yields. So, we had the 10-year up at 4.6 something and nearly 4.7% at once. It's come back a bit now in the US. And we've
Mm.
also got the broader question of the oil and disruption there, and the markets for, frankly, just ignoring what Trump is saying now because we keep having victory celebrations a bit too soon. Then it doesn't happen, and then it goes off again. Then it comes back again, and will it? Won't it? Well, I don't know. And then, interestingly, if you look at the whole oil story, it's a bit more benign than many people were thinking it might be, at least for the moment.
Yeah, yeah. Okay, and I think I do want to say to people, I think Martin and I, we're going to paint a few little pictures around in a few different areas, and then we
Mm.
will try and bring it all together at the end. So
Yeah.
don't sort of we're jumping a little bit back and forth, and I will come back to some of these other factors as well before we get to the end. Um, okay, so on the oil front, yeah, the interesting thing for me is we've seen now the IEA, which sort of which I think to me has got some relatively reasonable forecast in terms of the data about what's going on. It's always hard to tell, because you've got all these different industry bodies sort of putting this data together, and they get different views from different countries and all that sort of stuff like that. But look, they're basically saying that there's about 100 million barrels of oil per day of demand we're down to. So that's fallen a fair bit. And supply is at sort of about 96. And so it's been about 4 million barrels a day short for the last couple of months. And so that's sort of running down inventories. And then we've sort of got reports coming out. So China, for example, was strategist. I can't remember which. I think it might be JP Morgan strategist. Anyway, they're talking about saying they've just come back and they're actually thinking that they've changed all their forecast now. They think that Chinese demand has genuinely fallen about 10% for oil in terms of over the last little bit. And so there's been some meaningful changes in terms of the consumer behavior with higher prices, whether it just be more electric vehicles, more public transport, taking fewer holidays overseas, whatever it is, those extra fees are doing it. And so, if we're talking now at being 100 versus 96 in terms of demand versus supply, we have a 2% further fall in demand and a 2% rise in supply, and we're matched. We're back to all the markets even. Now, not to say that won't need higher prices or whatever it is, but at 2%, maybe that only needs $150. Maybe that doesn't need $200 or $250. There's been Iran talks, and again, there's a lot of fog of war going on, but Iran talks about, quite frequently they're talking about, oh, well, 25 ships went through yesterday. And on some of the days, the ships you've seen get through are sort of, one of the days earlier on in May, sort of 2 million barrel ships got through, which is 6 million barrels of oil, which is pretty close to it, or not pretty close, but it's they're putting through 20, and 3 ships in one day sort of got you a third of that back. And so there's sort of this part where making all the numbers add up is difficult. And you sort of talk about, oh, there's it's 20 million barrels offline, and it's like, well, actually no, it's probably closer to 13 or 14, and then actually there's more that's being shipped across through pipelines, and so maybe it's down to sort of 10 or 11, and then when maybe we had too much anyway in the first place, and then demand's fallen off, and so trying to get to the bottom of those numbers is difficult. And I guess all I'm saying is I've got a chart up just showing some of the scenarios from this is a Goldman Sachs one, but it's just sort of talking about commercial gasoline stocks on the right. There is so this was again, this was probably 2 or 3 weeks ago, but the red line there is basically saying, well, if you had a 1% improvement in utilization and some lower demand, then what was it? Then that you're basically flat in terms of where that's going to. And so, it ran through some additional ones where you're like, well, if things just keep going the way they're going, then you hit this level of danger once you hit, in September, November. But, there are you don't need that much that much in the way of changes to actually end up in a scenario which is like, well, maybe the world can live with this. Yes, it's not enjoying it. Prices are higher, but yeah, maybe there's a solution there that doesn't actually involve a full-on peace accord and all the rest that comes with it.
Yeah, and that, of course, does change the tenor. Although, of course, other commodities, including some of the fertilizers, big problem,
Mm.
particularly with
Yes.
the El Nino, which is looking as though that's going to be another factor that could actually suppress some crop yields as well. So some of these other ones could well be in the background. But it does seem to me that the tenor on the discussion about oil has definitely changed in the last month or two.
Yeah. Yeah. So, and it's this question about, you know, uh, there's certainly people in the oil industry who are just like, no, no, this is going to be a disaster,
Mm.
and this is all, five-alarm fire. You've got to do something about it right now. And then there ranges to other ones who are like, well, actually, there are ships getting through. There's stuff, maybe there's more than what we think in terms of it, and it's a different to 20 years ago. Yes, we were way more dependent upon oil, and there were far fewer substitutes, um, yeah, so there is uh, you don't want to say it's an all clear, but there's a lot of conflicting signs out there. I think
Mm.
in terms of where that takes you to,
Uh,
and I think the bigger picture for me is if it's sort of this, and I think I spoke about this last time, which is sort of why we flipped to being, when the piece sort of broke out, we flipped back and bought lots of equities, and sort of rode that up. Was that, yeah, if there's no solution. Trump's, never get to a detailed thing because he doesn't just don't have the negotiators and possibly the patience to get there. But there'll be lots of these mini just there's not all that war. And at some point, if you get more and more ships getting through, then you don't need the whole thing to be fully opened. If there's enough of a pressure valve that it's not a disaster, then and there's this AI boom going on and an earnings boom going on in the US, maybe the world can just handle that.
mm.
And I think that's where we're sort of sitting at the moment. If things get worse, obviously, if you start going back to war and the straits are fully closed and nothing's getting through, and particularly if they start bombing, each other's energy infrastructure, then there's bigger issues. But yeah,
And I think that's the point. The markets, I think, have pretty much decided to put their fingers in their ears and just carry on with the with the AI story in the meantime, right?
yeah,
Which sort of takes us quite nicely then to these floats, these massive floats. And it's interesting that John Authors, I think, was talking about the IPO that SpaceX is boldly going when no IPO has gone before.
yeah, yeah. So oh, look, first, let's talk through SpaceX because I think it's
Mm.
worth just. I wouldn't mind describing the company first, then the IPO, then the whole world that it fits into, and all that other stuff that goes with it. Because uh, so you've sort of got this company, and these are sort of more, yeah, like my rough notes around it. So don't read too much into this, but you sort of got this one, mooted at being 1.75 trillion. It's so the space division, if you look at it, okay, so it's loss making. It makes about four billion in revenue, um, but 50 to 75% of this is R&D. What they're calling R&D. Now, who knows how much of R&D is really R&D and how much of it's a real expense? Ordinarily, things like the tech giants probably spend 10 to 20% on R&D. If you look at a defense manufacturer, they're probably more similar to Tanner, more. You sort of think about defense manufacturers being quite similar to the space guys, and then a lot of the defense manufacturers do have space divisions. They spend way less on our R&D, but that's largely because the government sort of funds their R&D in effectively in the end. They have like 3 or 4% R&D budgets. So we know that 50% to 75% is way too high. But they're touting a lot of this on breakthroughs, and they've been, and benefit and keeping ahead of everyone else. And you do have to spend more when you're at the front of the curve rather than the back of the curve. And so if you do want to stay ahead of these other aerospace companies that they have, soundly beaten in a lot of this, there's going to be some spend. So who knows how much it is? But let's say you said $1 or $2 billion worth of profit for that. Um, you could put it on 30 to 60 times, I suppose, I guess. So maybe you've got a $60 billion valuation for that. Maybe you could get it to 100 if you wanted to be, generous on some other stuff. So it is, yeah, look, it's better than a lot of the other developer countries. Defense companies. They've done some really fantastic things in terms of costs, like just stuff where people in the industry just went, no, no, it's not, you're never going to get costs down that far, and they did. So it's that space side's really really good, but it's also in the place where uh, it's relying on government contracts for a lot of that stuff. Now some of it, what it's doing is then creating a commercial side, but let's talk about that in a minute. So that, but the government contract side, is relatively limited, and you can certainly screw the governments because your competitors have got costs that are so much higher, but there's limits to how much you can do on that. So that's there. They do talk a little bit about space mining and stuff like that, but I don't know. That's to me, there's still a bit pie in the sky stuff, and I think you need to see. Like I'm, happy to ascribe. Yes, there's some value to that, and it's a real option that you can grow into. But it's not like you suddenly have to say, oh well, these are going to be the only company that's ever going to work out how to asteroid mine. Yeah, and it could be 20 years in the future, but let's pay $100 billion for that today. That's sort of that part. Okay, so that's the space side. Then you've got the connectivity side. So the satellites. And this is growing. I mean, this is the real rocket ship, the business. It's growing dramatically. The users are growing at this rapid clip. The revenue is sort of $12 billion. They're making 70% margins. You know, they are making good profits in this area. This is one area that is making profits in it. And so uh, let's say you sort of in a few years' time, you'd go, okay, they grow from 12 billion worth of revenue, maybe they double that, and you're sort of sitting at $10 billion in profit, and you put it on 30 or 50 times, now you're talking about $350 billion. Is this, maybe you can get it to 500 billion. The total world telecommunications is only, about 2 trillion. So you're ascribing a lot of value to that. So I guess it's sort of a bit of a monopoly. It's going to be hard, very hard for anyone else to sort of put up that many satellites. Um, there's some limitations to the business though, in that it's really good at doing regional areas and really good at doing things like planes and ships. They'll probably make a bit more money from that, but it's not, that's never going to make a fortune out of selling data to airplanes or selling data to cruise ships. But we'll make something out of that. Uh, but part of the problem is there's only so many satellites you can stick over places, and satellites move around, and so ideally, people cluster together all in cities, and actually that's the part where you can't have enough satellites above the cities to be able to deal with the amount of data that they need, and so there is this sort of there's some limitations on the business, but really fascinating business, high quality, pretty decent moats, all that type of stuff like that. And then the just question is, well, how much are you going to spend on this? And that's the point is about, well, is it more than every other telco, in the world? They're going to destroy every other telco, and you're like, well, no, that sounds pretty hard. I mean, look, people go, yeah, I'd love to know that I've got great signal all the time, and I don't want to, I can, I don't get cut out by not being near cell towers and all that type of stuff. And you're like, oh, okay, well, great. How much do you genuinely want to pay for that? Because most people are paying, very, very low rates for their phones at the moment, and saying, well, and that's continual price war down is like saying, well, Elon does have to compete with people who are going, well, yes, I want to stream a video in high definition on my phone while I'm sitting on the train. Is like, well, everyone can't do that, using their satellites in cities, and so it doesn't seem realistic that he's going to take over the entire world telco network, and so it's a great business, fantastic business, throwing off lots of money, growing really quickly, but there's limits to how big it can grow, I guess is where that. The data centers in space is really fascinating, but again, really, really early. And so, two huge benefits of data space centers in space is one is it's really cold, and so you don't have to worry about the cooling anywhere near as much as what you do on Earth. And secondly, you get to see the sun, 24 hours a day, and so you can have solar panels, and there's your power, sorted and all that type of stuff like that. Great. But there's also the part that, these data centers do require a fair bit of human intervention and other stuff. And so, is this a, is this sort of similar to self-driving in terms of which I do think self-driving is pretty much is there now, like but Elon was telling everyone it was there in 2015 and 2016, and so if it is it a 10 years further than what you think, and it's always like, oh, we're just about to build these data centers, we're just about to build these data centers. Yeah, they're almost there. We're putting the rockets up, and so and again, these guys will have a benefit in terms of they can get these things up much cheaper than everyone else. But if these data centers are so valuable in space, then other people will say, well, if Elon won't fly my stuff up there, then I'll pay 4 times more to have somebody else fly it up there. And if it's so valuable, like the value is having the data center in space doing whatever it's doing. The value isn't in the getting it off Earth and into space. Yeah, it's great if Elon can do it for 25% of the cost of his competitors, and he'll have a real benefit in that. But it doesn't mean that he's suddenly going to dominate that entire area, and nobody else is going to do that well in that. So anyway, so that's your connectivity, which is sort of that quite an interesting part. Then you've got this XAI, and this is the part where so I spoke about the value before is so. This is basically most of their revenue. They got to maybe $3 billion in revenue or $4 billion, I think it was. Most of it's renting these massive data centers that they've got out. There's a little bit of revenue from X, and there's a very little bit of revenue from Grok, which is their AI thing. And so they've got these massive R&D costs. But is it R&D or is this just an operational? So they're basically saying, "Oh, this is all R&D. We're building these massive data centers." And it's like, well, yeah, but then you're selling the data centers, you're selling the calculations to people, and that's how you're making your revenue. So how's that R&D when that's it's basically it's capex and then you're getting depreciation. But they use a lot of that themselves. They use a lot of the processing themselves in this, and so. And we've got lots of these guys who have data centers. We can see the valuations of data centers around. So maybe you could put $40 billion maybe on this if you're very excited about it. X, sold for 40 something billion dollars 3 or 4 years ago to Elon, and since then it's halved its revenue. So maybe it's still worth So anyway, so you add all that stuff up, and you basically go, well, Grok and data centers need to be worth like $1 trillion to make this whole thing worthwhile. Now, OpenAI and Anthropic are both probably going to go for about $1 trillion, I think, in terms of their data centers, their things. But Grok's just got nowhere near the usage of either of them, and so and it doesn't score anywhere near as well. If they have a breakthrough and they jump in front of everyone else, they could. Anthropic went from nowhere, not nowhere, but fourth or fifth in the pack to all of a sudden the best one out there really quickly. So that could certainly happen. They've bought this company called Cursor, which will be fascinating because Cursor is one of these programs where it's a lot like Claude, where you can code. You basically code in it, and you can just choose which AI you want to use. And that's a big part with all these AIs is built into the system is it's actually really easy to flip between which ones I'm using. So anyways, Cursor is going to be, assuming it gets bought by Elon as once they list, then it'll get plugged into Grok as the default, so that as you open, you'll be automatically on Grok, but you'll still be able to change, I'm sure, across to use other models. And so that'll be this real test of this at the time, when we're forcing people to use Grok. Do they use it, or do they just all, is it a bit like what they call it, Microsoft Edge, where the most common use of Microsoft Edge is to download Chrome or Firefox, and so it just turns into, yes, we'll force feed people this, but they only use it for long enough to get themselves onto something else, and so that'll be the real test of that. But so the big picture wise, you need to think that Grok and data centers in space are worth $1 trillion. And given we haven't built our first data center in space yet, and Grok's a long way behind all its competitors that also look like they're worth $1 trillion, that seems a little far-fetched. And so, but Elon's got his attached to it, and there's a lot of people who really love Elon, and there's not much stock around. That's the big part, is that there's not much stock around, and it's going to go really quickly into the indexes, far more quickly than what it should do. And so, yeah, could I see that this, there's just some squeeze of, Musk fanboys and going into the index and all these things like that that just push the prices up? Yeah, absolutely. And all the people, they're all locked up, so as well. So there's what is it? There's uh I think there's only like 5 or 10% of the stocks available to be bought, and then you need to, yeah. Well, actually, we won't. I don't think we know yet fully how much is available to be bought, but they're all the people who are in there are locked up for at least 3 months, probably more likely to be a year for a lot of them, and so you're going to see that will gradually come out. But it won't be then that initial stages. And so, if in the initial stages it's like, big excitement, I want to put my money into data centers in space. Lots of Elon Musk fans buying up the stock, stock going into indexes, and so index providers all of a sudden, buying this thing up. Could it spike up, and then all the insiders then go, great, price is up 100%. Now we're all selling out our shares as fast as we can as soon as we get there. And so, yeah, that's clearly a potential. We will actually be having we're creating a tilt for these, a space tilt on our within our portfolios. So if you do want to get access to these, you can get access to them, but it's not one which I'm going to be buying in any of the active portfolios at the moment.
And just one other question: if this black hole emerges, a lot of people buying into SpaceX and maybe Anthropic, etc., money's got to come from somewhere. Are people going to sell other stocks to be able to actually get across? Or is there enough money outside that's not invested at the moment to come in that it's not going to dent the rest of the market?
Yeah, so day one, plenty of money around, no problems at all, because it's only $60 billion. Yes, it's going to be the biggest float ever, but it's going to be like 60 billion. Maybe they'll invest a bit more, but it's not a massive amount. So I'll show up this chart. This is actually, I think this came from John Authors actually, but it's just showing the amount of stock. The light blue line is the amount of stock available at the start of an IPO. And so 7%, this is for large IPOs with a low float, which is exactly what we're talking about for all these, Anthropic, OpenAI, and SpaceX. So 7% available on day one, but within 12 months, it's almost 50%, and then 24 months is well over 50. And so there's this idea that you go, okay, so let's say it's let's say it's 1.75 trillion, and half the people who are invested in at the moment want to get out, and so they're like, okay, the market needs to find $800 billion. That's a lot of money. That's going to soak up a lot of liquidity. And if the same thing's happening in OpenAI and the same thing's happening in Anthropic, okay, now we've got like $2.4 trillion that we need to find somewhere to get all these founders out. But the founders can't get out on day one. They'll have this, so at the start of it, there's like not much. And then as the more time goes on, the more these guys will then start selling their shares into the market, assuming, well, yeah, they will. They'll definitely happen. The question is, will it hit 50%? I don't know. That'll come down to the individual holders and how much they think about it, how much they like it. But there's a lot of people in SpaceX that have been in there for, I think, 10 years or more. And so they're obviously going to be relatively keen to get out at some point, or at least take some profits on that money. So that was one chart that was sort of interesting. The other two ones that sort of fit into this same bit is that if we bring up the number of US IPOs, the last 5 years have been really low. And so, if you look post 2000, it's sort of 100 companies a year. And at the moment, it's sort of been running at sort of 40 or 50 for the last sort of 5 or 6 years. And so there's sort of this lack of this companies. So there's probably a bit of pent up demand out there. And then the other one is, if you look at the amount of buybacks that go on in the market, and so the dark blue line is basically going, where are we buying back more stock than what we're issuing? And so basically for the last 2 decades, that's been pretty much the case for the entire period. That yes, there's been money raised for companies that are doing new listings, but actually there's more money being bought back. And so with all these companies, your Microsofts and Googles and Facebooks and all these ones who are just like, I don't know, I've got all this money, I don't know what to do with it, I'll just buy back my own stock. And so that has outweighed the amount of net new issuances. Maybe we're about to flip around and we'll actually start to see for, a year or two what the opposite's actually going to happen. Is that we might actually have more money coming into the market or more money needed in the market because we're issuing more stock than what we're buying back. And so, and you've got all these big companies who are like, well, I can't buy, yeah, I'd like to buy back some more stock, but actually, what I really need to build is build some more data centers because I'm making so much money on them. And so, yeah, maybe we're in this spot where there haven't been a lot of floats. We're about to get some floats. They're about to be really big. They're going to go into the indexes far faster than what they were than what they should because the indexes have changed the rules basically to bring them in earlier, and we've got fewer buybacks, and so maybe there's all this liquidity is going to get soaked up over the next year or so, far more than what we might have thought, and that's and if earnings turns at the same time, then there's your end of cycle and off you go. And so I'd say that's a very real risk we need to be aware of, and certainly one we're keeping an eye on, but it's not here yet.
Yeah, and interestingly, of course, the IPO route is often a cheaper source of funds than actually issuing more debt, right? Particularly in the current environment with debt prices being quite high.
Yes, yeah, that's right. Definitely more of an emphasis for companies. Yeah, when they can borrow at 2%, it's like fine. Why bother? Why bother having equity when I can borrow at 2%? But when it's going to cost you 6 or 7, then all of a sudden the calculus changes. There was something else I was going to talk about on this one. Else it's AIs. No, lost it. I will come back. I'm sure it'll come back to me though.
We'll put all the pieces together towards the end of the show, right? Because I think the jigsaw puzzle that we're painting is a really important one for people to understand, right? Particularly now, because there are so many variables in the story here, and then trying to make a decision on the back of that is an interesting challenge.
Yeah, that's right. Inflation. Do we want to talk inflation before we
should
go too far?
Yeah.
So I think I spoke about this last time. So we piled into inflation-linked bonds. My personal view is that, and our investment view is that there's no political penalty at the moment for having more debt. Trump is throwing off debt as fast as he possibly can, and most other countries you're not paying any political price for it, so you may as well just spend the money. And so to me, that says higher interest rates are more inflation.
Yep.
We've obviously got the whole thing going on around the energy costs. But look, even if that is solved, the question is, well, will we still have enough? So all of a sudden the Straits reopen, oil crashes to $40. Great, everyone's happier with that. But actually, have we still got governments out there spending money hand over fist? And you sort of, yes, it makes it slightly better, but the end result is that higher interest rate, higher inflation. We saw minimum wage was up 5%, 4.5%. So I think there's enough within this to say you need to be aware of inflation and there's a long-term view on it. And I'm going to come back to that with this. So there's two parts to this. One is inflation-linked bonds. Secondly, you probably want stocks over the longer term. So if you're worried about inflation over like a 5 or a 10-year period, then stocks is the thing that's going to help you in terms of stocks. And the ironic thing, we'll get to these government rules, but if we do go through a period of high inflation now, this new capital gains tax might raise less revenue than if we hadn't kept the old one.
Exactly.
And I'll go through the maths for you to talk about that, as a big picture sense.
Yeah. And it's an interesting little angle here. Debt is Great asked, do you think there could be a market dislocation? I feel investing is too hard and risky at the moment, especially in Australia. And it sort of goes back to, well, is cash your friend at the moment because of those higher interest rates? People can get 5% plus in terms of term deposit for more secure, maybe. But over the long term, if inflation is actually eroding, your future is probably going to be more secure if you invest, but you've got to invest right to be able to make that work, right?
Yes, exactly. It's Yeah, it's a part of if you in any period in history, if you've just said, "Oh, I'm worried about inflation, I'm going to leave my money in the bank,"
Mm.
you're going to end up way behind on that. Yeah. Whereas stocks, you can always buy stocks at the wrong time. You buy at the peak of a bubble, you're going to lose money on it. You buy at the bottom, you're going to look fantastic. Regardless of the rest of it, rest of things going on. But over a sort of a period where you go, let's look at periods of higher inflation. What are the best assets to get you through those periods? They tend to be stocks,
Mm.
and because they're usually putting money. They're usually the companies that are putting their prices up, and that's sort of the reason why they'll keep track with inflation at least, or if you can get the better ones, they'll do better than inflation.
The other interesting observation, and Walsh is now, of course, taken over as Fed chair, and there's a discussion that maybe he's going to change the basis on which inflation is measured, right? So trimmed
Right.
mean rather than actually, the PCE inflation, which again
Yeah.
changes the goal in terms of, well, yeah, it's not as bad if you look at trimmed mean inflation, and of course the trimmed mean in Australia went up this last
Mm.
time round, despite the fact that the headline came down because the headline, was actually saved by the change in the um, petrol excise duty that was reduced by the government. So the government put squeeze on the headline, but not the underlying, right? So, I don't believe any of these inflation numbers in any case.
No, well, look, the reality is everyone's got their own inflation rate.
Yes.
And so, if I'm not out, if I'm not out there buying nappies, then who cares for me if nappies, there's no effect in my spending if nappies double or triple, but for lots of other people out there, there's a huge issue for it.
Mm.
And so, and if you own an electric car, then, and, I have an electric car, and so petrol price doesn't really matter, Whereas my kids are constantly coming around and borrowing it and saying they don't want to drive their car because they don't want to pay for the petrol prices. So there's everyone's got their own inflation rate, and I think that's the part where we're talking about averages of averages of averages, and so yeah. But I think probably your point is the more important point. I think which I've sort of probably sidestepped there is that if you have a desire to get to a certain point, which is say lower interest rates, then you can start changing what you're measuring
Yeah.
and get there. And one more sort of reason why we might be seeing higher inflation over the coming period is that the US isn't as concerned about it.
Mm.
And look, he's Walsh has made the point, and I do think he's got a good point with this, is that during the internet boom, is that not Bernanke, sorry, Greenspan had taken the view that, look, there's a huge productivity gain and we can't quite see it yet, and so we're going to we're going to hold interest rates a little bit lower than what we might have otherwise done. And I do think there's probably a reasonable point to that. I do think we're going to see some pretty reasonable gains in terms of AI, and there might be technological changes which are sort of beyond the immediate view, that you can get lucky with this, and all of a sudden, and maybe driverless cars is the one in the US. They've I think Google's now in the last 6 months gone from 250,000 trips a week to 500,000 trips a week, and growing dramatically. They're getting into this exponential stage, and so if there's if that breakthrough happens and we see more driverless stuff, kick off in the next coming, 3 or 4 years, then maybe there is a huge negative deflation shock on that, as the cost of delivering everything suddenly doesn't need a driver and goes down quite substantially.
Mm. Yes, and of course there was some discussion over the last few weeks from some firms saying we might be able to reduce some of our human capital. In other words, less people.
Yes.
The Pope obviously came out and said, no, AI is important to think about in a different context, which is it's not the same as being human, which I thought was quite an interesting take on all of this. So there's some really big stakes here. But coming onto the inflation specific, the award from Fair Work Commissioner, 4.75%, right? That's the annual wage review, which is higher than it was the last couple of years. And I think it's about 21% of the workforce that is actually impacted by it. But of course, a lot of those people are not full-time workers. So the actual real impact on the wage price index itself is going to be quite a lot lower than that headline number. But
Yeah.
nevertheless, there's probably a little bit of a question of, well, does it set a benchmark then for other people looking for another wage rise because of the higher inflation? And the Reserve
Mm.
Bank has been very, very paranoid about this a cycle of wage expectation leading to higher inflation expectations, leading to higher wages, that sort of whole cycle. So
Mm.
it's not going to help the RBA, is it?
No, and I also suspect that a lot of the industries you're in are a lot more price sensitive or the lower margin businesses. I think that that's part of the reason for them having so many low, minimum wage workers is they tend to be a low margin business,
Mm,
and so when your wages go up by that, you have to then put your prices up by
yes.
that. Whereas if you're a much higher margin business with higher paid employees, maybe you can like, well, my revenues rose by 3% this year, my salaries grew by 5, maybe we've got a bit of a margin squeeze going on for the next year or two,
Mm,
as
mm,
opposed to going, well, if I've only got a 1% margin and all of a sudden if my this has gone up, I just literally have to raise my prices, otherwise I'm going out of business. And so I do think there's a certain element to that. But yeah, and I, this is the part where we were talking about last time, which is you have a pandemic, you go through this low inflation, we have a pandemic, burst of inflation. Yeah, maybe it was one. Everyone's saying it's one off. Maybe it is one off. Then we have energy crisis in Europe and around Russia and Ukraine. Another burst of inflation. Okay, maybe it's a two off, and now we're up to the no, take three on this. Is at a certain point it does become ingrained, and secondly, we do not have governments who are keen to squash it. There's yeah,
no.
they seem to be, or also, in some countries, or particularly the US, the central bank that's pretty happy to let it go.
And talking about governments and what they're doing, we should sort of segue into the budget, right? Because, of course, this budget actually was a taxing bigger budget to be able to find more money to spend on more things. So the size of the government debt is still going to rise.
Mm,
And they're doing it through changes to capital gains tax and to the negative gearing for property, but also more broadly too. And I think
mm,
a number of people are trying to sort of get their head around what are those implications. I've never seen so many posts and tweets about CGT and things like that as I
I
have.
know.
But it seems to me that there's some really important things to understand here. Uh, I'm fascinated by the fact that almost everybody's just accepted the CGT and negative gearing changes for property. It's like, okay, yeah, well, it was always going to happen at some point, and all the evidence suggests it's going to have a depressive impact on property and property prices. But this
Mm.
broader canvas of the CGT changes is opening a whole big can of worms, isn't it?
Yeah, yeah. So we've put up, we've got a model, we have a calculator for people, and it's not live yet, but we will put it up. And I'm hoping tomorrow. I think we're just checking the last numbers and make sure it all adds up. But I thought I'd show some results at least for you to see. So because it's not until you play around with it and you start going, just a minute, those numbers are wrong, and then you get dig into it and you're like, oh, actually, no, they're not. They're right. There's a whole bunch of things that actually are far more important now than what they used to be. And so I will get there in the end, but I'll just I'll walk slowly through this first to show you just an example of one where we say, look, I've got somebody say born in 1965, so 60 years old, with $100,000 and expecting going to invest in some shares and get 8.5% with a 2.5% inflation rate and then retire. And so you go, okay, so this is just sort of sitting at the bottom of the end and going, okay, if we put that person in, let's say they're earning $100,000 at the moment, they've got a portfolio that sort of turns over every year, buys and sells some stock. And so, they'll run out of money in 12 years and they'll need the pension or whatever it is on this. But I just want to sort of go through and go, 80% of it's going to sit in super and then 20% will sit in their individual. And then we show up these different tax bills. What were your taxes under 2026 rules, 2027 and 2028? And so this person goes, yes, they're going to pay a little bit more as an individual if they put all this as an individual. If they leave most of it, these what I'm showing now is if you stuck all your money, your entire amount into as an individual, your entire amount into superannuation, your entire amount as a company, entire amount into a family trust, or you did a blend of the above. And so that person's going to end up paying, as an individual, you sort of you go from a 9% tax rate to a 17% tax rate if you put it all in that. If you put it all in your super, it's really not, it's not going to change. And then yeah, then a couple of others. Okay, so that's sort of the base level. Then you say, okay, well, what about if you've got a couple with $1 million and earning $100,000 a year? And then same thing, husband, or sorry, one partner working, one not working at the moment, both 60, and then they're looking to retire. And you go, okay, well, so if you put it all as an individual, they're going to pay, and these taxes, they're going to pay about $15,000 more in tax over 20 years. And tax rate's going to go from about 16% to 17% for that. But, within a super fund, they actually did have a jump up, and the jump up was actually the rules that are already in place. So you went from a 1.8% tax rate to a 2.5% tax rate, and most of that 1.8 was before that person actually retired. But because of the Div 296, eventually they hit a limit and they start paying some extra tax there, assuming that the things don't move. Um, and so you go, so it doesn't change for the 2028 rules, but it does change, from that. And then, chances are though you're going to do some sort of blended one where you sort of sit, I've just sort of said 40% in both people and 10% in their own names, and you end up with this. Well, you're probably going to pay a little bit more in tax, or sorry, a fair bit more in tax. Maybe an extra $1,000, bit more than $1,000 a year. But yeah, your tax rate's actually it's only going from 2.5% to 4.5%. So yeah, not massive changes in that. Okay, so that's your $1 million. Step it up to $2 million. All of a sudden, some of these figures like the superannuation numbers really just start to grow a bit more. And again, though, the tax rates, that I think that's the thing people are missing in a lot of this is the tax rates really aren't changing that much in terms of what you're paying. So, if you're a couple with $2 million at the moment between you, you're going to retire in a few years' time, you're probably looking at sort of on this is your tax rate on investments of being about 3% if you're sort of blending it between superannuation where it's the most tax effective but holding a reasonable amount in your own name as well where you can earn up to $20,000 tax free. Yeah, you're talking about going from a 3% tax on investments to a 4.5% tax on investments. So yes, it's going to be $2,000 a year extra in tax you're probably going to pay, but yeah, the actual tax rate is still very, very low on most of these. You jump to 10 million, now you're making some big differences. But again, like most of this difference was all the Div 296 rules. That was what really made the big kicker. So if you're an individual, you're like, well, I would have paid 25.5%. I'm going to pay 26.7. It's not a big difference in terms of in terms of what's happening. The bigger change was actually, in superannuation with 2026 rules, you would have been paying 15% tax. You've actually gone to paying, 26% tax for somebody with lots of money on that. But again, under all this stuff, if you're blending it, if you're saying, well, it's a couple with $10 million, so I'm splitting it between two people, and then I'm splitting some more money into each individual's personal names, you're probably still only paying 15% tax or lower on your and if you start working some family trusts and some other stuff in there, it's it can be significantly lower than having it all in super. And so actually, sorry, that's a great example. All in one person's name in superannuation under the 2028 rules, you'd be paying $4.5 million in tax over 20 years. If you've got it blended and you're mixing it between the different assets and spreading it all out, it's it's not quite half that, but it's probably 30 or 40% less. It's at least a few $1 million less in tax of that. Now, so that's sort of big picture wise what's going on. I'm going to use the uh, I'm going to use the couple with the $2 million as a sort of more, I guess, central case for this, just to show an example. So the top one is that the taxes you're paying in your portfolio based on a 20% turnover. I'm saying, well, if you instead of doing that, you went to something like a direct index, like the ones we spoke at Martin a little bit earlier about direct indexes and ETFs. So you go to a direct index. Now, the benefit of direct indexes is you actually own all the stocks in the index. So rather than so if you own all the stocks in the index, what tends to happen is a new stock will come into the index and it'll kick the bottom stock out. Now the bottom stock is usually fallen in price. And so sometimes you do have to sell a few more of the stocks that are the bigger stocks. But if you've been gradually buying these stocks over time, with using, say, the dividends to go out and buy the more stocks, then yeah, okay, I've got some Nvidia that I'm up 300 or 400% on, but I bought those 3 or 4 years ago. I bought some Nvidia last week, and and that's actually that might be down on happens to be down on price. And so if I need to sell some stock in order to buy some SpaceX because it's coming into the index, then I can sell the Nvidia I bought last week and take capital loss. I can sell the stock that's getting kicked out at the bottom, which is might be something like Novo Nordisk or something like that that's fallen. So that's actually taken a capital loss as well. And so the net effect is you never actually have those capital gains events, and that you just get to drag that out forever. And so, the difference of saying if I invested in the same return with a 20% turnover versus a 3% turnover, I've not quite halved my tax, but I've gone pretty close. So on a blended version, I've gone from $140,000 worth of tax over 20 years to $80,000 worth of tax, or 4.4% tax rate to 2.5. If it's all within an individual, it goes from a 20% to a 12.7. So massive differences depending upon the assets you're choosing within those. So yeah, anyway, that was one thing I wanted to highlight. And the other one is this idea around inflation, and the idea that if you get high enough inflation, actually, I won't. Probably better if I don't show this, but better if I just explain this one. Is that if let's say you're talking about high enough inflation where it starts to change the real return. So if I'm paying interest, so let's say I get an 8% return, and under the old scenario, sorry. Yes, so let's say I'm going to get an 8% return, but 3 of that's dividend and 5 of that's coming from yield. So 3% yield, 5% return. Now that 5% return gets compound, and I'm going to pay tax on half that. So I'm paying tax on 2.5% of that money. So that was under the old rules. So effectively, yes, I've got to pay tax on the dividends, obviously, but on the capital gains, I'm getting 5% per annum capital gain, and I'm paying tax on 2.5% of it. Now, if we go to a higher inflation rate, and I go, okay, so now I'm looking at this same return, 8% return, 3% as dividend, 5% as capital gain. But let's say inflation's actually 3% of that 5%. Well, now I've actually only got a 2% real return on that. So I'm paying tax on the 2%, not the 2.5%. And over time, that's where that chart, now, okay, I guess I can bring that chart back and show you, is that if we're in a period where under this first one where I made the assumption that inflation was 2.5% and you might have got an 8.5% return on your stocks, is you're going, okay, so you've got the 2027 rules where you're paying 19%, and then under the new proposed CGT, your tax rate's going up by 1%. Well, actually, if we go to a period where it's only 8% return and 3% inflation, I'm actually going to pay a lower interest rate. I pay a lower tax rate on that than what now. So I guess it's almost for the Australian government. You might be careful what you wish for. Like in that you might be hoping for all this extra money, but if we're about to go into a period where inflation's higher, real returns are lower, they might have been better off with the they might have got more money out of having the 50%. So yes, that's some big picture thoughts about the weird stuff that maths does.
Very interesting. So 3 observations. The first observation is it's complicated, right? It's got way more complicated, which probably means that more people will need to get advice from their accountant or from their financial planner to navigate it. The second is that the inflation calculation, if you've held stocks for 20 or 30 years compared with 3 years, you probably have more leeway in terms of the benefit. So
A
Holding,
little bit, because I think the main thing on that one is it depends what your assumptions are
mm,
about your returns. Because I think the thing to think about is think about the real return you're going to get on this. Because in the end, it's the that's what you're going to pay tax on is that real return.
yeah,
And um, so if I get a real return of 5% over 2 years, or I get a real return of 5% over 20 years, I'm still going to be paying that same, I'm going to be paying tax on that 5%. So it's not like I get better. It's not like it gets better for me the longer it goes on, if that makes sense. So under the old system, it's like, yes, you needed to hold this asset for at least 12 months to get your 50% discount. Under the new one is you still get all the benefits of compounding, but
mm,
as long as your real growth rate is the same, it doesn't actually matter whether you're selling and moving into a different asset, I guess is where I'm trying to get to. Yeah.
yeah, no, good point. And then
Oh, sorry. Except that you're raising. Sorry. Except that you're realizing that gain and having to pay tax, which is a bad thing, I suppose. I've actually I've just undermined my whole argument there. Yeah, you do want to hold on to assets as long as you can. Yeah.
I think you do. I actually think
Yeah.
that
Hmm.
holding longer rather than shorter probably makes more sense. Third point, of course, is this is still okay. It's been legislated at the high level, but it's still sort of got to go through a bit of is it a Senate inquiry, and they might make some changes, and there's a lot of pressure from various parts of industry and things. So, I wonder whether a lot of this focus on this broader canvas is deliberately to obfuscate the real change around property, which
Yeah.
no one
Yeah.
is talking about,
Oh,
right?
look,
Everyone's
I've had
panicking about the fact that property prices could fall.
Yeah, that's right. And look, is this so the question is it just bait and switch? And is this the same thing with Section 296, which as I showed you on those charts, that's a much bigger change for a lot
Yes.
of people, especially rich people, than what you
Yes.
think. But because they put out this, oh, we're going to tax unrealized gains on it, everyone was like, hey, can't trust me tax unrealized gains. And then eventually it's like, okay, fine, we won't tax
Exactly.
unrealized gains. Oh, did you notice we just upped your tax rate, on
Mm.
some of those charts, some of those numbers, for the $10 million people,
Yes.
they're doubling their tax or more. And so, I do think there's an element of that within this. And so, yeah, I certainly would not be restructuring your entire portfolios around this. But what I would say is, we'll put this up tomorrow, and I'll get you some links for it. But I just want to show this one. This is sort of the one we've got where we're just showing. This is for the richer one. So you can see under these new rules, which of these lines, if you invested it all in a company, all in a family trust, all in an individual, or all in superannuation, you sort of end up largely in the same spot with all of them, which is what I think the intention was. But this yellow line at the bottom is the blend. And I think that's the part where people are like, for this one, I've gone, okay, look, if you put 35% in both partner super and 10% in a family trust and 10% in each of their names, you actually end up with a far better result than sticking it all into one asset. And that's the one which I think I'd love people to have a quick play around, because at low balances, no, it doesn't really matter. Whether is as an individual or yourself, you definitely don't want it in a company, but you stick it in yourself, you stick it as in your super, doesn't make that much difference. Whereas the amount of money you have can really make a difference as to which structure you choose and the blend that you decide to use in terms of the proportions. And I wouldn't be don't look at this and optimize it to the third decimal place, because tax rules are going to change. That's for absolute certain. But at least if you sort of got that rough thing about, oh, okay, well, if broadly this is my asset mix, or broadly I should be putting more into super or less into super and more into my own name and things like that, I think is well worth keeping in mind.
Yeah, and my general observation here is that this is a continuing story, right? But it's something that you need to be across, or if you're not across, then get the right advice as you go forward, because it can make a really, really big difference to what actually happens in terms of overall outcomes.
Yes, absolutely. Yeah, tens, hundreds of thousands of dollars of money that you can, just by not having the right structure.
Mm.
And I think as well, the other big thing, I just haven't got to this end of tax year thing, because that's sort of moving into this one as well. The more money you have, the more forward planning you need to do. So I think big picture wise, we'll talk a little bit about things you should do towards the end of the year. But if you want to be putting money into switching money from your own name into your super fund, like you can do as of 1 July, you'll be able to do $130,000 a year. You'll be able to do the first 3 years, you'll be able to bring through 390. You can do that for both yourself and your partner. So if you're saying, oh, look, I've got six or $700,000 worth of money in my own name that'd be far better off being in my super fund because where it's tax free and everything like that, fine. You can get it within a couple of years, you can get it there relatively easily. The issue is if you're talking about millions of dollars and you're looking to shift things around, it's a gradual process, or it's and the earlier you get started, the better. And there's big tax incentives now and greater tax incentives to be in super. And so making sure that the annual ones, you're using up as much of these annual benefits as you can, at the moment, because it's saying, well, the one thing that's come out of this is that investments in your own name and are now much worse, or companies or trusts or whatever it is are now far worse than what they were in a relative sense. But superannuation is for the first smaller part of it is still, or the first sort of $2 million in particular is still the best place to be sticking money to save yourself on tax.
Yeah, and again, it's important to get that localized individual advice. This isn't financial advice. It's just your general observation about the need to take account of structuring. As you say, you can't do it all at once. And we're coming up to the end of a tax year. So do as much as you can this year and then do some more next year. That's the sort of, so again, it's really important to have a little bit of a forward plan around this sort of stuff rather than just leaving it to the last minute and then panicking to try and do something, right?
Yeah. And so the thing, especially thinking in terms of the last minute now, so you want to get your what you'll call your concessional payments into your super. Now it needs to be in there before 30 June, but a lot of super funds have earlier cutoff dates just because of the processing and all that type of stuff that needs to go on. So, I would really you should be thinking about it right now. Like if you're not doing it in the next week or so, you might end up with a super fund and you might end up missing out. And so, just you think you've got to be in by the 21st on your super fund, and it might be a BPay payment, and BPay takes 3 or 4 days or whatever it is. So yeah, I think in terms of that, well worth thinking about that now. So checklist, things to do. Is that where we wanted to move next?
Yeah, just before we do that, two quick observations. Right, it's 30K, isn't it? I think the limit that you can do on an annual basis. So potentially moving money across, and it's quite beneficial to do that because it reduces your personal income as a result for tax purposes.
So big picture. I mean, the big picture one I always say is, let's say you're on $200,000. If you get $1,000 pre-tax, and you take that outside of super, you're getting taxed 47 cents in the dollar. You have $530. You started with 1,000, you have 530. You put that into super instead, make an extra payment into super. You started with 1,000, you end up with 850. So going from $530 in outside of super to $850 is a 60% return on day one. Now, we've got some good performing portfolios. I can't guarantee you 60% on day one. I don't think anyone can. That's one of the best deals you're getting out there. And even if you're on a 32% tax rate, you're still getting a significant gain. It's still like a 20% return on day one. And so obviously that money is tied up. You're not going to see it for a long time. So there's a negative side to that. But also for younger people, particularly people who are saving for a home, you can put it in as a first home buyer super scheme, and you get that same benefit within that. And so, there's lots of tax issues, but there's lots of higher tax rates. But this is the one thing they're basically putting the stamp on to say, yes, we're still keeping this as being very beneficial to do that.
And Jason asked, and Jason asked a question: what stops the government changing the rules on super once people have moved excess cash to super? Can we trust the government not to change the rules? Does planning work without that logic? Within that logic, and the point is, nobody knows, right? What you can be sure, what you can be absolutely sure about, there will be more changes to the tax and superannuation rules in the future, despite what they might say at any one point in time. It's a political issue which is going to go on and on and on. So you can only make plans though on what you know currently. You can't box shadow.
And
shadow box.
There's two things I'd say to this as well. One is what's clear is superannuation is designed to be more tax advantageous so that people save more money for their retirement. And that's the whole basis of it is if they change the rules so that it was less tax advantageous, you've basically done away with the whole reason for super. So do I think they will change the rules so that you will be better off? You will go, oh, I wish I had kept that money in my own name rather than super. No, I don't. And for all the squealing that everyone did around the whole Division 296 and all that type of stuff like that, if you turned around to any of those people and said, "Oh, you've got your $50 million in super, and now you're not paying 15% tax anymore. Now you've got to pay 40% tax," and they're like, "Oh, I'm paying all this extra tax and never would have done it." It's like, well, do you want to take all your money out? You can stick it all in your own name if you want. Oh, no, 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 no! I'd be paying far more tax than that. I don't want, I don't want to do that. So
it's still relatively better, right? Yeah,
exactly.
Yeah.
And so, and so there's this part about saying, so there's one is, do I think that super is going to stay the most efficient one? Yes, I do. I still think it is. So in relative sense, maybe there'll be a movement around and things will change. But secondly, is that whole part about, even the ones we've seen so far, the changes they've made to super generally haven't been anywhere near where the stage where you're going, well, I wish I never did it, because you got all these massive tax benefits from it. Yeah. Over the time. And then they're pretty, they generally do seem to grandfather things rather than stop them immediately as well, rightly or wrongly.
Well, let's move to your end of year tax year checklist, right? Because there are some things that it's worth just going through before we get to the end of the year, isn't it?
Yeah. Okay. So there's first thing. So let's talk about getting money into super, physically the process of doing it. So there's basically the two parts, the concessional and the non-concessional. But I think the easiest way to think about it is the concessional stuff, they're going to tax you. So you're going to put money, you're going to take money and you're going to put it into your super, and they're going to tax you 15% on it. So what the money you want that to be is either additional payments from your pre-tax pay. And so you basically tell your employer, make additional payments from my pre-tax pay, and then yes, I'll get charged 15%, but it's better than what I would have been charged, if I hadn't have done it. Okay, so that's one way. You go straight to your employer. You don't have to fill in, once whatever forms your employer makes you fill in, but you don't have to do anything in the tax department. You don't have to report to the government or anything like that. Secondly, you can make a payment yourself into your super fund using after-tax money and claim a tax deduction on it. And so this is a concessional contribution. There'll be rules and regulations for different funds around what you need to do in order to do it. But basically what happens is, you'll say I transfer $1,000 into my super fund. My super fund will pay 15% tax on that. So I'll take $1,000 of my own money from my bank account. Only 850 are going to end up with my super fund. But I'll then get a bit of paper which I'll turn around to the government, turn around to the tax office when I do my tax, and I'll say, give me the tax back on that $1,000, and if I'm on a 32% tax rate, they'll give me back the 15% I paid plus the extra 17% as well. If I'm on a 47% tax rate, I get all that back as well. So you put money in, you get back money when you do your tax return on that. But there are terms and conditions around that, so make sure you get them right. And then the other thing you can do is you can make what's called a non-concessional payment, and this is just transferring money into your super fund, which won't get taxed at all. And so so the first ones, you got the limit of $30,000 a year that you can do on those. Yeah, actually, sorry. Let me stop before I go on to the ones that aren't taxed. So in the concessional ones, you can do $30,000 a year. But if your superannuation balance was below $500,000 at the start of last year, at the start of on 1 July, then you can do you can bring forward. So you can use up some of the prior payments that you didn't use. So you got 5 years worth of back history you can do on that. So you should check your MyGov site, find out how much you've got, and try and use that all up if you can. And particularly if anyone's got a balance where they're like, they're at 450 last year and actually now they're over 500, this is your last chance to do that, to use those. Okay, so that's your concessional ones where you'll put money in and you'll get taxed, but then you'll get taxed back. Okay, so then you can go, you can just transfer money with non-concessional, where you're basically just saying, I'm taking the money, sticking it in my super fund. You can do $120,000 this year, and you can do 3 years worth of bring forward.
but it's going to 130. So if you're thinking about doing the 3 years, bring forward and say, oh, no, do 120 now, wait a month, and then do 390, in on July 1, if that's the way. And so you ended up with 500,000 that you could shift across. And so there's age limits, there's balance limits, there's a bunch of things in there. But the thing with this money is it's basically getting your money out of your name into your super fund. It'll get taxed at any earnings that you have. So it won't get taxed when it goes in. Anything you earn on that will get taxed at 15%, or 10% for capital gains. And then when you retire, provided you're under the $2 million, then all that's tax free. And it's one thing it is worth thinking about when you're doing these, if you're part of a couple though, is trying to even out some of the superannuation balances. So it used to be that it didn't really matter, whereas now they're putting in more of these limits for each person. And so if you had, say, $4 million as an example, all in your own name, you're paying lots of tax on that. If you could split that $2 million in your partner's name and $2 million in your name, now you're paying no tax. And so, if you're looking forward to that, and particularly if you've got one partner working and one not, is going, okay, I need to start trying to even up those balances if you can, with a view to, look, you never know what's going to happen in the future, but they do seem to be moving more down this path of let's tax higher people with higher balances. And so if I can even them out, there's significant, tens of thousands of dollars you can save on that. And then the two ones you've got as well are for lower earners. So one is if you have a relationship and one partner's earning a low salary, there's you can put some money into you can deposit up to $3,000 into the person with the low earning salary, and you can get a $540 offset on your own tax. So that's one rule. There's lots of rules around that again, but that's one to think about. And then the other one is, again, it's for low earners, is that if you're under 47,000, I think is the large bit, and they get a bit of a partial up to 62, but you can basically deposit up to 1,000 and they'll give you an extra $500. And so your benefit is more money into your super fund. And so rules and restrictions around all this stuff, but and there's some posts up on the Nucleus Wealth site you can jump onto and to have a look at those. But they're your big ones for end of year, trying to make sure that you've got your money in the right accounts. And then around the new stuff, I don't think there's. I think it's worth waiting until you see the end result of what the final what the final thing comes out to be in terms of the tax rules. I certainly wouldn't be urging you to close down family trust or start up new family trust or whatever it is until you get there. And look, the Liberals have clearly have said that they're going to roll a lot of this stuff back anyway. And so, just be
if.
Yeah, that's right. but I do think the big thing is when you're looking at these is, look, you need to look at it and genuinely work out what benefit am I getting. Like, I've seen lots of ones where it's saying, okay, oh look, I'm going to set up this complicated structure. It's going to cost me $5,000, but I'm going to be saving $3,000 a year. And you're like, yeah, but you're going to be paying an extra $2,500 in accountancy fees every year. And you're like, oh, okay. So I'm getting a $500 benefit, doing all this weird and wonderful stuff for accounting and extra tax returns or whatever you're doing to get there. And you take your accountant would love to do it. Sure, he'll take the extra $2,500, but maybe you're like, well, for the extra $500, and in 3 years' time they change the tax rules, and I'm behind on the whole deal. And so, I do think there's a quantity you need to sort of work out. Is this worth doing? Is it genuinely? What are the legal risks I'm taking, or even just the extra? If you don't like doing your tax return and all of a sudden you've got to set up 4 different entities in order to be able to do this, and you're like, oh, now I'm doing tax returns for my trust and my holding company and this and that, and it's a sort of a question about how much am I really getting out of this?
And I've got a perspective, maybe I'm right, maybe I'm wrong, but this idea of doing everything to minimize your tax, to my mind, it's something you think about, but it shouldn't be the ultimate reason why it is that you're doing what you're doing.
Absolutely. You should not be minimizing your tax at all. You should be maximizing your after-tax returns. because I'll tell you right now, Martin, if you got $1 million to invest, I'll tell you exactly how you can save as much tax. Stick it into a savings, a transaction account at any one of the big banks that give you absolutely no interest at all, and you'll pay no tax at all because you won't make any money on it.
Yeah.
But if you want to get, what you want to do is you want to choose, and that's very much with mine is, anytime you see somebody start any investment seminar talking about the tax benefits, is like air raid sirens, you're out of there. You should never be thinking about the tax part. You should be thinking about what are my pre-tax returns first. Make sure that makes sense. After that, okay, now what vehicle am I going to put it in? Sometimes you might go, I'm going to get 10% pre-tax, but actually, after tax, I'm only going to get 5. Actually, now I'm going to say it's not worth it. Or pre-tax, I'm going to get 10%. After tax, I'm going to get 9. Great, I'll go with that. But there's you should never be coming the other way and going, I'm going to save all this money on tax, and so therefore I should do this investment, because you'll end up in the front pages of the newspaper when they're talking about XYZ thing blew up and lost money for all these people, and they're usually the ones that were driven around tax.
Absolutely. And just to say to Jason, thanks for the super chat, Jason. Really appreciate it. And I wanted to say thank you on air last week. I missed it because I got waylaid. So as we come to the end of the show, I think 3 quick sort of bringing the thoughts together, right? When you think about investing, you've got to be thinking over a longer period rather than a shorter period. You've got to be thinking about the overall returns rather than the tax. The other is Australia versus the rest of the world. Australia is not doing that well. When you look at the returns in Australia, the banking system is looking a little bit wobbly with regard to performance now because of what's happened with the changes to the mortgage books and things like that. So some of the best opportunities are probably not in Australia but overseas, and that means you need the right vehicles and the right structures to be able to actually access those, to be able to actually maximize your overall returns. The taxing follows.
Absolutely, yes. And I think that's where, we pitch this idea to people around these, a lot of these, the direct index funds or our active funds. But the idea is that you've got this core holding where you can hold, we will invest the stocks for you. And as I spoke about, if it's a direct index, it's very low turnover. You're getting larger stocks, and you can do some tilts, and you can do a few little things yourself where you're like, look, look, I believe in the space story. Give me a space tilt, or I don't like nuclear, or I do like nuclear. Take nuclear out of my portfolio or add it in, whatever it is. Some small tweaks around the edges, but the core structure you're buying is something that's set up to be tax efficient, low cost, and fit within other stuff you're doing within that. And so that's that sort of core thing. And then around that as well, if you then want to go buy a few other stocks yourself or buy something else, it all fits. You've got this core portfolio that you can sort of play around the edges with, and then other things like that. If you're out there saying, oh no, I'm gonna stock pick, I'm gonna put all my money into SpaceX, and then I'm gonna yank it before the whole thing comes tumbling down, and I'm gonna put it into something else, and then I'm gonna bounce around and bounce between those. You not only have to get the timing right on all those calls, but as I showed you on that thing, if your turnover is too high, particularly under the new capital gains tax rules, all of a sudden you're going to be losing that benefit of compounding and that whole idea that I'm building this portfolio that's just, and the stocks that are in there are the ones I'm holding on for as long as I can, and I'm only selling the ones that are where you're down, and you're sort of realizing those, often realizing capital losses. Like we look at our international direct index fund is up sort of, I think it's like 17% per annum or 18% per annum for the last 5 or 6 years. But within that period, there's a couple of years that made taxable losses because the stocks that were selling were the ones that were the smallest ones. And so, it's probably up 2.5 times over the whole period. But it's in terms of capital gains, it's been very, very little in the way of capital gains. And so, that structuring the assets and getting it into the right vehicles is really important.
And of course, the whole idea of what the World Funds and Nucleus Wealth Platform is enabling people to do that simply, straightforwardly, with some different bells and whistles and variations available, depending on how sophisticated you want to be. But it's really transparent. And that's the other thing that I think I want to underscore. A lot of the other stuff that's out there, you don't know where you are, you don't know actually what's going on, and it's very hard to actually read whether it's going the right way or not. What this platform here offers is effectively transparency and openness, which is Well, I think
Yeah,
really important.
Yeah, absolutely. And that's the main thing. We want you to know what you own. And so, great example just the other day of somebody senior executive bank, and he's like, well, I want you to run this portfolio for me, but I don't need any of the banks because I've got lots of bank shares myself. It's like, well, fine. That's you. That's exactly you're going to see the will be a weird performance and everything, but his overall looking at his overall portfolio, he's like, yes, he's happy with what he's got. He's got, all this stuff without banks, and then he's got his banks in his own name. And that's exactly the type of thing we're talking about in terms of, the structuring and tailoring to and transparency that lets you do those things.
Absolutely. Well, I think we've pretty much come to the end of the show, unless there's anything else that you want specifically to highlight, Damien.
Oh, no, there's 1,000 things I think we've missed, but I think we feel like we've been through a lot today. I think we jammed it in.
I think we have jammed it in, but I think it's been a really fruitful conversation because it shows you how all the pieces can cohere if you actually think it through. And I want to say thank you.
Oh, actually, sorry, I do have something I did want to. That was what I wanted to think. Bring it all together. Sorry, yes. One quick thing for bringing it all together. Yeah, overall, I think the main theme I think you would have heard with a lot of these things I was talking about is there's some short-term things look pretty good. There's a whole bunch of these risks that are sort of over the horizon, whether it be the liquidity issues with all these IPOs coming on, whether it be the earnings side that we saw in terms of Micron and those types of ones, whether it be the oil side, and is there something bigger? And there's a lot of these issues out there, but none of them are imminent. The house is on fire right now. It's a look, if it doesn't cause harm and there's other things that happen that are positive, the economy can get over it. And so I guess what I'm trying to say is it's a very volatile time to be investing right now. But the theme though as well is if you just tipped out and got out of this, you would have missed a lot of these gains. And I don't think it's quite time to be doing that right now. I think we need to wait till we can see more concrete signs. There are lots of things that are a little bit concerning, but that's always the case in investing.
And, if people had dialed out 6-12 months ago, they would be significantly down now. And unfortunately, what I quite often see is people panic at the first sign of a bit of a downturn. We've had several downturns over the last year, 18 months. If you'd bailed, you would have missed the upside. So again, having a strategy and holding to it, I think is pretty important.
Absolutely.
One last quick question here from Andrew. Is there a minimum amount to invest?
No. We're happy to take, usually $2,000 is sort of, but people who are, it's not a high number, and we do kids accounts and all that type of stuff like that, and we'll bundle together. So if people have superannuation accounts with us, we'll take the admin fees off some of the other ones, or kids accounts. If we've got kids accounts, we'll remove admin fees for those types of accounts. So yes, and
I want to underscore that the fees are actually important too. In some other systems that are out there, the fees are a lot higher. And much less transparent. Again, it's important to understand because the fees can erode remarkably.
Absolutely. So, and for us, it's all about the variable fees as well. So you can invest lower amounts without having to worry about that, and we'll bundle together everyone's trades so that you're not sort of going, okay, there's not this. Oh, there's a $5 fee to trade stocks or anything like that. We buy partial shares. We try and do it so that. If you stick another $100, we've got plenty of people who just stick $100 a week or $100 a fortnight or whatever in there, and we just invest that with big packets of things. And I think you pay on $100, you might pay 9 cents in trades, and we might buy 50 shares for you with it because we're buying fractional shares and all that type of stuff. So very much set up for that. Continually investing over time, building these portfolios up, giving you that longer term solution of a good tax outcome, a good fee outcome, and a good investment outcome.
Damien, I want to say thank you so much. You've covered a lot of ground. You've earned your corn tonight, so thank you for that.
Thanks, Martin. Great to speak again.
We'll do it all again next month. We'll be a week later next month because you're taking a bit of time off in the top end. So we'll look forward to that. And links and things below for those who want to follow on from Walk the World Funds and Nucleus Wealth. It's all there. And I'll look forward to catching up with you again next time. And I hope you have a nice break in the meantime.
Thank you very much. We'll speak soon.
Okay, I'll take you off and clear the show. Thanks. See you later. There you go. I hope you enjoyed that really interesting conversation. Next month, Damien will be back, as I say, a week later. Next week, we're going to have a conversation about the property market specifically and get some perspectives from the point of view of a mortgage broker and what they're seeing with regard to the recent changes and how that plays into property. So check that out. The dogs are still here. They've been nice and quiet, and hopefully they'll be fine when I take them out for their walk. We have a thunderstorm approaching, so I'll try and take them out before it rains. Anyway, thank you very much for spending time with us this evening. Please like, share, subscribe, and thank you for all those who super chatted as well. Really appreciate that. We'll see you next live show next Tuesday, and check out the recorded shows each day of the week. Martin North from Digital Finance Analytics signing off. Take care.